Hello, everyone. My name is Maroon. I'm the VP of Operations at Farhat Accounting Lectures, and I'm more than happy to guide you through a diluted earnings per share CPA exam simulation. In this session, we will explore a comprehensive example to enhance our understanding of how to apply the if-converted method for convertible securities. Two key assumptions regarding this method. The first one is that it should be used to determine the dilutive effects of the convertible securities by computing the potential effect on the numerator and denominator. So we're going to compute the effect first on the numerator and then on the denominator. And then we're going to compute the ratio of this effect and compare it with the basic EPS. Compare it with the basic EPS. If it is less than the EPS, then it is dilutive because it's going to reduce the basic EPS. And it's going to be, in this case, included in the computation of the diluted EPS. Second assumption is that the securities were converted to common stock at the start of the period or upon issuance if later. So if the convertible securities were issued in the prior years or at the beginning of the year, we're going to assume that they have been converted on January 1st. However, if they were issued, these convertible securities like such as bonds or preferred stock, after January 1, we're going to use the date of issuance, the issuance date, and consider as if they have been converted since the issuance date. We're also going to practice how to implement the Treasury stock method for options. And this method is also used for warrants. It considers options and similar instruments dilutive only when the average market price of the common stock exceeds the exercise price. In this case, these options would be called in the money because the option holders can buy them for a price lower than the market price and gain from the difference between the exercise price and the market price. Now, if the market price is lower than the exercise price, then a reasonable person would not pay more money for the exercise price. And in this case, if the exercise price is more than the market price, these options would be called out of the money, and they would be anti-dilutive. They would be disregarded from the computation of the diluted EPS. The second assumption for the Treasury stock method is that the company will use the proceeds from the exercise of stock options, warrants, and similar instruments to do what? To repurchase shares at the current market price. And bear in mind that the additional shares, the additional number of shares that will be added to the denominator of the diluted EPS will not be the number of shares exercised, but it's the difference between the number of shares exercised and the number of shares that are assumed to be repurchased. These all are assumptions. So assumed to be exercised minus assumed to be repurchased at the average market price. Let's go ahead and get started.
Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
The following table is an excerpt from the balance sheet of CPA Corporation as of December 31st, 2000 X4. We have information about long-term debt and stockholders' equity. To compute the diluted EPS, we need to look at convertible securities. Notes payable are not convertible securities, so they're not going to affect the computation of neither the basic nor the diluted EPS. Here we have two convertible bonds, two types. One is 7% and the other is 12%. these are going to be considered. We're going to apply the if converted method on these two types of convertible bonds. We have also 10% cumulative convertible preferred stock, $10 par, 80,000 shares outstanding, and their par value is $800,000. Also, this convertible preferred stock will be considered in the computation of the diluted EPS. We have also information about common stock, $5 par, 400,000 shares outstanding. Additional paid-in capital, retained earnings, they won't affect the computation of EPS. Below are the key assumptions and notes relevant to the fiscal year ending December 31st, 2000 X4. The first information is that throughout the year, 400 shares of common stock were consistently outstanding. So here they made our life easy. We don't need to compute the WACC, so it's already provided as 400,000 shares. Second information, in December 2000 X3, so before the beginning of this year, the current year, options were granted to purchase 10,000 shares of common stock at a strike price of $30 per share. So we're going to compare this with what? We're going to compare it with the average market price, which is $32 per share. Now be aware, the year-end market price will not be used in determining whether these options are dilutive or not dilutive. So we're going to compare the exercise price, which is 30, with the $32 of average market price. And since the exercise price or the strike price is lower, these options are considered dilutive. And we need to compute the additional shares and the computation of the diluted EPS. Third information, the company issued 7% and 12% convertible bonds in 2000 X2. Also, these bonds are outstanding since the beginning of the year, which also can make our life easier. Both at their face value, each bond with a face value of $1,000 can be converted into 10 shares of common stock. We're going to see how we're going to use this information related to the face value in order to compute the number of convertible bonds since it is not provided. At the start of 2000 X4, 10% cumulative convertible preferred stock was issued at par value. So also the preferred stock was outstanding for the whole year. Each preferred share can be converted into 4 shares of common stock. The company's average income tax rate for the year was 30%. We're going to need this information to compute the interest expense savings, which is going to be net of tax. Dividends on preferred stock were not declared in 2000 X4. Is this information relevant? Actually, it is not. Why? Because the preferred stock is cumulative. We're going to compute the dividends accumulated during the period, regardless of whether they have been declared or not. Now, for non-cumulative preferred stock, we need to consider whether they have been declared or no. But for cumulative, no. We're going to always compute what accumulated during the period. So we're going to disregard this information. The net income for the year 2000 X4 was $2,400,000. This is going to be included in the numerator of the basic and diluted EPS. Throughout 2000 X4, there were no conversions of bonds or preferred stock into common stock. Great. What are we required to do? Compute the basic and diluted earnings per share for the year ended December 31st, 2000 X4. We're going to start by computing the basic EPS using the formula income available to common shareholders, which is net income minus preferred dividends, divided by the WACC, so weighted average number of common shares outstanding. We have our net income, which is $2,400,000, and we need to compute the accumulated preferred dividends during the year, which is the $800,000, the par value multiplied by the 10%, and it is 80,000. So 2,400,000 minus 80,000 is 2,320,000. This is our numerator. And our denominator is provided as 400,000 shares. So the basic EPS is 2,320,000 divided by 400,000. It is $5.8 per share. Next, we're going to start computing the diluted EPS by first considering each convertible security separately and determining whether it is dilutive or anti-dilutive. We're going to start with the first security, convertible bonds, 7% convertible bonds. We're going to calculate the impact on the numerator and specifically net income. Why? Because bonds affect net income through the interest expense incurred. And we're going to consider the savings from the potential conversion of these bonds into common stock. We're going to consider this interest expense net of tax because the effect on the net income should be considered net of the effect of tax. First, we're going to compute the interest expense by multiplying the total face value of 9 million by the interest rate of 7%, and then multiplying by 1 minus the tax rate. The tax rate is 30%, so we're going to multiply by 1 minus 0.3, and the interest expense saved net of tax is 441,000. That's the impact on the numerator. What about the impact on the denominator or the WACSO? To calculate the number of bonds payable, what we need to do is we can apply here the rule of 3. So for each bond, the face value is $1,000. How many bonds have a total face value of 9 million? So we're going to multiply 1 by 9 million, and 1,000 times x equals 9 million. X equals 9 million divided by 1,000, and the number of bonds payable is 9,000 bonds. What about the incremental shares? It's the multiplication of the 9,000 bonds by the 10 shares per bond, because each bond is convertible to 10 shares. So how many shares are going to be converted using the if converted method? 90,000 shares. So finally, we're going to compute the ratio of the impact on the numerator and the denominator. We have an additional 440,000, which is an adjustment to our net income. It's the interest expense saved net of tax. And we have 90,000 of additional shares assumed or to be converted since the beginning of the year. So 441 divided by 90, and the ratio of the impact is $4.9. What do we need to do now to determine whether these convertible bonds are dilutive? Compare the ratio with the basic EPS. If it is less than the basic EPS, then these convertible bonds are dilutive, which is the case here because we have 4.9 is less than 5.8. These bonds are dilutive and must be considered in the computation of the diluted EPS because they are bad news. They are going to reduce the basic EPS if converted. Next, we're going to look at the 12% convertible bonds and use the same method, calculate the impact on the numerator. We're going to multiply the interest expense by 1 minus the tax rate. The interest expense is 4 million multiplied by 12%, multiplied by 1 minus 0.3, and the interest expense saved net of tax is 336,000. What's the impact on the denominator or the WACSO? We're going to apply the rule of 3 also here. So the number of bonds payable is 4 million divided by the face value of $1 million. We have 4,000 bonds. Incremental shares is the number of bonds multiplied by the number of shares or common shares converted per one bond. So 4,000 by 10 multiplied by 10 is 40,000 shares. This is the effect on the denominator. What's the ratio? The ratio of the impact is 336,000, the addition to the numerator, divided by the addition to the denominator. and the answer is $8.4. Now, this amount is higher than the basic EPS, and therefore, these convertible bonds are considered anti-dilutive and must not be considered in the computation of the diluted EPS. And why is that? Because we never show good news, potential good news to shareholders or investors. We only can show, or we are required to show bad news to these investors or shareholders so they can be cautious in their decision making. This is the rule of conservatism. Next, we're going to look at the convertible preferred stock, and we're going to do the same thing, calculate the impact on the numerator. There is no impact on the net income. Now, remember, the numerator of the basic EPS is net income minus preferred dividends. Preferred dividends do not affect net income because they are part of equity. They are payment to shareholders, preferred shareholders. They're going to reduce equity and not net income. So here, there's no effect. But by converting to common stock, the company can avoid paying the preferred dividends, and the whole net income would be available to common shareholders, including the newly converted shareholders. So, assuming the preferred shareholders convert to common stock, preferred dividends are no longer paid, thus income available to common shareholders increases by $80,000. There's no consideration of tax here because equity is not taxable. The preferred dividends are not taxable. Next, we're going to calculate the impact on the denominator. The incremental shares are the 4,000 preferred shares multiplied by 4 common stock per preferred stock, because each preferred share is convertible into 4 common stock. 4,000 multiplied by 4, the incremental shares are 16,000. The ratio of the impact, so we have preferred dividends saved 80,000. This is in addition to the numerator. And the addition to the denominator is 16,000 shares. So 80,000 divided by 16,000, the ratio is $5. It is less than the basic EPS, and therefore the convertible preferred stock is dilutive. It's going to reduce the basic EPS, and therefore it must be considered in the computation of the diluted EPS. Next, we need to consider the stock options, but now using the Treasury stock method. Using this method, we first need to compare the average market price with the exercise price in order to determine whether these stock options are dilutive or anti-dilutive. Since the average market price is higher than the exercise price, so here it is 32 and not 35. We're going to take the average market price. Then the options are considered in the money and are considered dilutive. We're going to calculate the impact on the denominator, the WACC. So there's no effect from the conversion of stock options on the numerator because they're not going to affect neither the net income nor the preferred dividends. But they're going to affect the denominator because the company will have additional common stock. So we're going to calculate the number of shares that could be purchased with the proceeds from the exercise of options. The proceeds from the exercise equals the number of options multiplied by the exercise price. So number of options is 10,000 multiplied by the exercise price of $30, and the proceeds are $300,000. The number of shares that could be purchased with the proceeds equals the proceeds from the exercise divided by the market price, the average market price, because the company would have to pay $32 in the market to purchase a share. So the real loss is the difference between the $32 and the $30. $300,000 divided by $32, the company can repurchase 9,375 shares with the money collected from the option holders. What is the number of incremental shares? It's the number of shares that could be exercised from stock options, which is the 10,000. So they're going to issue, if converted, 10,000 shares, minus the number of shares that could be repurchased with the proceeds, which is the 9,375 shares. And the addition to the denominator is 625 shares. Finally, we can compute the diluted EPS since we know all the elements that need to be added to the numerator and to the denominator. We know what our securities are dilutive. So the diluted EPS, we're going to take in it the numerator of the basic EPS and the denominator of the basic EPS and make some adjustments to the numerator and the denominator related to the diluted or dilutive securities. So what are we going to add to the numerator? We're going to add the preferred dividends. Why? Because the preferred stock is dilutive. And in case these preferred shares are converted to common stock, the company will avoid paying these preferred dividends. And the whole net income would be available to common shareholders. Same thing applies to the interest expense saved. This is related to the 7% convertible bonds because they are dilutive. In case they are converted, the company will save the interest expense on these bonds. In our denominator, we have the WACSO, and we have adjustments related to additional shares from bonds, preferred stock, and options. Now notice only the options are going to only affect the denominator. They're not going to affect the numerator because there's no effect on neither net income nor preferred dividends. So the diluted EPS is 2,400,000. This is the numerator. This is the net income minus the preferred dividends of 80,000. We add back those preferred dividends because they're going to be avoided if converted, if the preferred shares are converted, plus the interest expense that's going to be saved, also net of tax, remember. So interest expense, always remember that it is net of tax. And these are the changes to our numerator. What are the changes to the denominator? We have the WACSO 400,000. We're going to add to it 90,000 shares related to the convertible bonds. And we're going to add to it the 16,000 shares related to the preferred stock. And we're going to add the 625 computed related to the stock options. So these are the changes to the denominator. Finally, our diluted EPS is 2,841,000 divided by 506,625. The result is $5.608, which is less than our basic EPS of $5.8. Always the result of the diluted EPS needs to be lower than the basic EPS, or else we have to recompute to make sure that we did not do any mistake in the computation. Thank you for watching. For additional resources, you can go to Farhat Lectures to help you with your CPA exam and your accounting exams.